A dividend investing strategy for retirement can provide stable income indefinitely without touching the principal of your investments. This means you would never run out of money, in theory, and you'll receive regular income like a paycheck. This sounds great, but there are some potential issues that could arise. Owning stocks that go down in value can cause you to lose money even when factoring in dividend payments. Also, some companies will simply stop paying their dividend for various reasons. Ideally, you want to own stocks of healthy, profitable companies that make stable payments while the value of the stock rises over time. That way you receive cash flow and depreciation. Where can you find healthy stocks that grow and provide income? There's a group of dividend stocks that are categorized together that have a high likelihood of continuing to make their payments. These are called Dividend Aristocrats. Take a look at whether or not this group of stocks could align with your goals. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. A Dividend Aristocrat is a company in the S&P 500 that has not only paid but increased its dividend every year for 25 consecutive years. The list of companies is analyzed every year and updated accordingly and must meet certain size and trading volume requirements. Their impressive history of dividend growth makes the list of companies very attractive to own. You might be wondering why these companies are so special if dividends are supposed to be paid out on a regular basis. That is why people like dividends, right? During unprofitable years such as 2020, some companies simply can't afford to continue making payments. Last year, various companies cut or suspended their payments completely as they faced pressure in a market of uncertainty. This list of companies included big names like Wells Fargo, Dick's Sporting Goods, Carnival, and Goodyear. No companies are immune to financial turmoil, but those with a long, stable history are considered reliable. There are many established businesses on the Dividend Aristocrat list that we've likely all heard of, such as 3M, Coca-Cola, Johnson & Johnson, Pepsi, McDonald's, and more. 3M, Coca-Cola, and Johnson & Johnson boast an incredible 57-year period of dividend growth, while Pepsi sits at 47 and McDonald's 43. With a total of 64 Dividend Aristocrats, they all seem to have some traits in common. Most of the companies provide products or services that are recession-proof and are needed in various economic cycles. For example, 3M earns the majority of its revenue by selling industrial, safety, and healthcare products. Coca-Cola earns its revenue primarily from soft drinks and snacks, items that sell well in any market. McDonald's is actually busier during poor economies since people are skipping high-end options and looking to eat cheaper. Johnson & Johnson earns its money from products like Band-Aid, Tylenol, and Benadryl. It's likely any given stock is either in the consumer staples category, industrials, materials, or healthcare with very few consumer discretionaries. Of course, a major advantage to these companies is that since they're all similar in nature, most of them perform well during recessions. This is due to the resilience previously mentioned, but also due to their payment history because investors know that they can rely on them for stable income with a very small risk of seeing the dividend cut. They're all mature companies who aren't growing at high rates, so they have the stability that investors are seeking during bear markets when many companies stop paying dividends. It's also unlikely that extremely large companies will fail or even see major disruptions during market cycles, making them appear virtually indestructible. They're established and aren't spending huge amounts of money on growing, so they're willing to pay higher dividends. Since each aristocrat is held in the S&P 500, it also meets that index's pricing, size, and profitability requirements that make them safer and generally sound investments. Downside risk is limited when compared to high-growth alternatives that don't provide income and are growing at fast rates. On the other hand, stability does come at a price of lower overall returns over the long run, as is the case with most dividend stocks. Just because a company pays a stable dividend doesn't mean that it's automatically a good company. A history of regular payments does provide some insight into its financial health, but it's only a clue. Last year, Procter & Gamble, which is also on the Dividend Aristocrat list, had a payout ratio of over 60%. This means they're paying out over 60% of their earnings to shareholders in the form of dividends. While it's a stable company with a long history, it's recommended to stick to a payout ratio of 50% or less. Otherwise, the company could potentially be spending more than it can really afford. Some companies even borrow money to fund dividends to make it appear healthy to shareholders and so it can keep its dividend status. That type of behavior should be a red flag, and it does not inspire confidence in its investors. If you're considering purchasing one or more of these stocks, it's obviously not as simple as just selecting companies at random and raking in profits. For those with the knowledge to analyze the fundamentals of individual stocks, the Dividend Aristocrat list is a good place to start, but that doesn't mean proper due diligence shouldn't be exercised. They still require proper analysis of their financials, as well as taking a look at their share price to determine if it's reasonable. 3M might be a good company, but buying it regardless of price is similar to purchasing a home without considering its list price, just because it's a good house. It could very well be a good house, but chances are you wouldn't buy it at whatever price the seller is asking. When it's put that way, it sounds completely ridiculous to make a decision in that manner, yet people do that every day in the stock market. That's not investing, but merely speculation. The problem is that people don't understand the businesses they're buying. The easiest way to reduce risk is by knowing what the company is that you're buying and how it protects itself from the competition. ProShares offers an ETF that provides you the ability to purchase a fund holding solely Dividend Aristocrats called the ProShares S&P 500 Dividend Aristocrats ETF with the ticker symbol NOBL. The yield isn't particularly high at about 2%, but you'll also be receiving capital appreciation. How much capital appreciation has this returned, and how does the performance of this ETF compare to the S&P 500? Over the past 5 years, the S&P 500 has returned about 17% annually, while NOBL has returned over 14%, both with dividends reinvested. ProShares also charges an expense ratio of 0.35%, which is significantly higher than what Vanguard would charge for an S&P 500 ETF, for example. There were few periods where the list of Dividend Aristocrats actually outperformed the market during recent times. One thing to remember when choosing Dividend Aristocrats is that since a company must have raised its dividend for 25 consecutive years, you're limiting your selection of stocks to a very small list. Put another way, there are many financially sound companies, but they don't make it on the list for various reasons. Either they haven't been around long enough to qualify, haven't been paying dividends long enough, or simply haven't made dividend payments a priority, instead focusing on growing the business. Apple initially went public in 1980, over 40 years ago. They raise their dividend periodically, but management decides to reinvest in new products and technology to fuel further growth to reward its shareholders with capital appreciation as opposed to cash flow. Ignoring Apple as a potential investment 10 or 15 years ago would be leaving money on the table. Owning companies that have increased their dividends year after year, even during recessions for decades at a time, could allow you to sleep better at night. The Dividend Aristocrats can help boost growth while building an income portfolio for retirement. However, since all of the Dividend Aristocrats are listed in the S&P 500, you could just purchase that instead. The yield will be slightly lower, but growth has historically been higher thanks to the high growth exposure primarily to technology stocks. The desirability of perpetual dividend income could cause you to overlook other superior investments. Before sacrificing overall returns for income, ask yourself if you're doing it for a retirement strategy that will be useful in the near future, or if you're simply doing it because you enjoy the idea of dividends. If you're young, chances are that you'll be better off in the end by utilizing higher growth alternatives.